But if we simplify the schemes that are there, make them actually viable and actionable, and simplify that planning system, we should be able to certainly improve the delivery that's happening.
So Kate, as you know, one of the main areas we focus on in real estate in Deloitte in Ireland is the provision of housing. And we work with some of the leading house builders in the country. As you're aware, it's one of the main social, economic and political issues of our time, and a real challenge to provide the level of housing required in the economy at the moment. What's the data telling us?
So we've been through an incredible 3-year period, really. We come through COVID, multiple lockdowns, and come out the other side, and where we've really had quite a challenged market during that time, as so have many other jurisdictions and countries. But when we look at the housing market, we look obviously at supply demand. It seems basic, but there's huge elements within that to tell us an awful lot about how the market is performing. So if we look at demand first, so I also look at pricing on the first basis. So how have residential prices moved over the last year, particularly as those interest rates have begun to increase since middle of last year? And what we see on a national basis, your prices are rising at about 7.6% on an annual basis. For Dublin, that figure is a little bit lower at about 6%. So that's your annual figures. But on the monthly data that is released, we are beginning to see a little bit of a change. There is a softening in your monthly increase, and within Dublin, we're seeing a very marginal decline. However, on an overall basis, we're not expected to see large scale or significant declines in your overall price movement within the market, both at a national and a Dublin perspective. Why do I believe that? It's when we look at mortgage data. So mortgage approvals, mortgage drawdowns, they're one of our best indicators for where demand is tracking within the market. Again, if we look at figures on an annual basis, from about November of 2022, so November of last year, we had about 56,000 mortgages approved on an annual basis. That's not any much of a change from where we had earlier in the year. Where there is a little bit of movement is within your first-time buyer cohort. But again, it's about 28,000 on an annual basis, and it's just marginally back from that peak demand crunch time during early of last year, April, March, May time period. The last part of that, what we always need to remember, is also your population figures. So we finally have Census 2022 data. We didn't have a census since 2016. And from that, we've seen the population is continuing to increase at a pace that is faster than what people anticipated. We're now up over 5 million. We're at our highest level since Census 1841. So I think it's clear demand is there within the market. There is no doubt that there is plenty of demand. Where our concern lies is still within the supply side of the market. And again, I look at planning permissions, commencements, and your completions data. So completions for last year were quite positive. We had over 29,000 units complete in the market, higher than where government targets were, and all around our highest level for quite some time, since great financial crash era. But where the concern is more so on our commencements data. So commencements for the year as a whole were lower than that. They were at just over 26,000 units. And if that's to track through to completion, it gives us lower completions than where we were in 2022. It's also lower than where government targets are. And there is a concern on where those commencements numbers will go as the year progresses, with all the other challenges that are in the market as well. And I think when we look at it then, there's probably 3 main key issues at present. That is your planning, your viability, and your funding side of the market as well.
So if we look at those 3 areas, I mean, demand, I think, is unquestionable, as you say. And in fact, probably the numbers we need to be looking at more 50,000 units rather than in the mid 30,000s. So demand, unquestioned. Price is holding up in most areas of it, but it really does come down to viability. And we'll come on to planning shortly, but when we talk to our clients, they're saying viability is their biggest issue. Significant cost price inflation over the last 12 months in particular, And although that might be easing, it's certainly not. Not reducing. So from a viability point of view, particularly for the higher density units, that seems to be an increasing issue. What we're seeing from funders is for viable schemes, there is funding available. There are a lot more tools out there at the moment that were available previously from the banks, direct lenders, and from equity providers. Although appetite has come back, we still have always managed to raise funding for viable projects. So viability, particularly for high density, we see as an increasing issue.
And is that funding appetite, that small change that has happened there, has that come off the back of that interest rate environment that has now changed from where we were previously? We have an increase of over 300 basis points since last July. I think the ECB made it very clear that in March we were going to see another 50 basis points rise, and probably a little bit more to come from that. We look to the States, to Canada, to see where that is tracking. But I'm assuming that has changed the dynamics within that market and is impacting that appetite, or is it more on that viability side?
No, I think you're absolutely right. I mean, if you take on high density, build to sell for apartments worked in very few locations in the country anyway, even pre the interest rate rise. It was all being done off yields, so institutional buyers buying blocks of apartments, and because that gave a higher cap value because of the yield, it became viable. But as costs continue to rise, but interest rates also pushed out the yields, even marginally, a small movement in those yields narrows down the equity gap and creates makes a lot of schemes unviable. Concern we would have looking at moving on to planning now, the concern we would have is a lot of the schemes that are currently caught in judicial reviews actually aren't viable anymore anyway, even if the judicial review was overturned and they were granted their planning. They were designed and the planning was applied for under different assumptions than what are prevalent in the market at the moment.
So essentially, when we see those figures floated of how many units are tied up in planning, be it 40,000, 50,000, 60,000 units, that really only an element of those are still viable today. You bring up a good point when you speak about that institutional investor side of the market as well. And I think that's when we really look at the challenges that are going to happen over the next 12 to 24 months. And essentially how you solve them is because we're quite aware that with that change that has happened in the market, that change in that yield environment and costs overall, that sentiment within your institutional investor side of the market has certainly changed. And I think there's a concern for the level of activity that will come through from your institutional investors. They've delivered a huge amount of volume to the market over the past number of years. We've seen our apartments completions rise to account for the majority of your completions in 2022, most of which were in Dublin. And that, again, a huge proportion of those have come from those institutional buyers. I think if we look at investment stats over the past few years, residential has accounted for the larger proportion of it, with over 6 billion coming from that type of investor. If a substantial amount of that capital has left the market, how do we address that shortfall? How do we address that viability gap? Is it these schemes that we're seeing coming through from government, or how do they interact with your lenders?
Well, from what our clients are telling us, there's two ways of addressing it. One is for higher density, you need to bring that back to medium density so that there isn't the same level of sales risk. You're not building 90 apartments at a time and having the sales risk. You can't build one apartment, you have to build them by blocks. Yeah. So that phasing that you can do with lower density and housing makes it easier to fund and there's less risk. It's all about risk and reward. If you reduce risk, you attract in capital. So looking at the types of planning that are coming through, the levels of density and the level of capital that's required up front and the sales risk that capital is taking, if you can reduce that down to medium density, reduce the sales risk, it may make more of these projects affordable. The other area is clearly state intervention.
Yeah.
The state has to intervene in a meaningful way, both at the infrastructure level and also at the sales risk level. And so the sales risk level, the LDA can be used as a backstop, and they're becoming more active, and we've approved housing bodies. So from that sales point of view, there are mechanisms there that can be looked at. On a cost point of view, as that infrastructure could be an area that the government could get more heavily involved in with the likes of HISCO and try and make that more affordable for the developments, and also phase it out over a long period of time. The other area is direct intervention into the costs of building higher density. And we've seen a number of schemes that are being looked at the moment, like Croí Cónaí. But in terms of that, there are areas within Croí Cónaí that still make it quite difficult to fund. Certainly the back end in nature, and the fact that it can be reduced at any point in time. And there's no mechanism within that system for a developer to pass on costs. So again, it adds a huge amount of risk. And that risk is adding a premium onto the funding cycle as well. So for state intervention, it needs to look at reducing risk and reducing costs.
Yeah, I think for me, the key is as well, so we've made it clear, I suppose, that private institutional side of the market is going to be quieter this year than what it had been previously. So government or state have a huge role to play. And there are plenty of schemes out there. There is money put forward in Budget 2023. We have 2.3 billion allocated to housing. And there are quite a lot of schemes that do warrant or should yield good outcomes from them. But I think the key for me is actually making sure, as you said, the likes of Croí Cónaí had, that they are actionable and actually viable. So are they workable? Does the government need to actively listen to the constructive feedback which is presented to them from many different bodies across the industry? Because we're never going to solve this issue if we just throw plenty of capital at it, have many different schemes, but schemes that we know deep down need tweaks, need information, changes to happen for them to actually work. And I think Croí Cónaí is a very good, clear example of that. I do think government are beginning to get a little bit more open to being receptive to changes that need to occur. But unless that happens and we see actionable changes that make those schemes attractive to the people wanting to invest in the market, we're not going to solve the issue.
No, and as we know, it's a complex issue. It's not something that you can just address by delivering on one area of housing. It's a complex issue that takes time. So you've got to look at the complete cycle of housing, taking land through zoning, through planning, having the right infrastructure there, having the services available, and then looking to deliver on the housing units on that land. So having policies that address all of those issues, and we come back to planning. Planning is a significant issue now because it is really affecting what is happening at the back end of here. So it's affecting what's happening in the zoned land, and it's affecting the appetite of equity to come in at this level. And the industry itself needs to attract equity into the early stages of land, because putting debt into that part of the cycle is too risky. So when we talk to foreign investors and we talk about taking planning risk in Ireland, the ones who've done the research really don't like the risk profile that they're seeing. So we need to simplify our planning structure. Yes. We need to ensure our planning structure is de-risked to the extent that it can be, to allow capital to come in to bring units through that entire cycle in an economical and viable way.
We do have the changes happening from a planning perspective with the Planning Development Bill announced only since the start of the year. Obviously, there's quite a way for that to go for it to be actually enacted, but there are potentially positive changes that would come from it, and I do believe need to happen fast. And I think in one way you've summed it up quite well there with that word of simplification, because when we step back and look at this problem, this market as a whole, it is simple economics in one sense, demand and supply dynamics. Yes, within that there's lots of intricacies that make it a difficult market to get your head around. But if we simplify the schemes that are there, make them actually viable and actionable, and simplify that planning system, we should be able to certainly improve the delivery that's happening.
I think that's right. And you know, from our clients and from some of the main industry players out there, there is significant capacity to deliver on these units. There is funding available, and at various terms and conditions. So between capacity within the industry, clearly there are challenges, but there is capacity there. There are a lot of very well capitalized home builders, who will build on viable
And
sites,
want to
build on
yes.
viable. That's what they do.
Yeah.
And so if there's viable sites there, the funding is available and the government supports are available, they will deliver units.